Today, a lender can reduce a person's financial history to 3 digits. A computer collects information about past payments, outstanding debts, account age, and recent applications. Within seconds, a bank can decide whether to approve a credit card, finance a car, or offer a mortgage. But imagine walking into a bank before that number existed. There is no credit score. There is no nationwide database. There is no instant report showing every account you have opened. The banker sitting across from you cannot press a button and discover whether you paid another lender on time. So how does he decide whether you can be trusted? He might ask where you work. He might contact your employer. He might examine your property. He might speak to merchants who know you. He might require another respected person to guarantee your debt. And in a small town, he may already know where you live, who your family is, and whether people believe you keep your promises. Before credit scores, financial trust was not calculated by an algorithm. It was investigated, discussed, recorded, and sometimes judged through reputation. That system could be deeply personal. It could reward people with strong community connections, but it could also exclude newcomers, immigrants, women, racial minorities, and anyone who did not fit a lender's idea of a respectable borrower. And there is another surprise. For much of American history, ordinary people did not receive most of their credit from banks at all. They borrowed from shopkeepers, employers, relatives, pawnbrokers, small finance companies, and local merchants who kept handwritten records of what their customers owed. The modern credit score did not replace a world without financial surveillance. It replaced a world in which surveillance was performed by neighbors, store clerks, investigators, employers, and loan officers. This is how Americans borrowed money before a number decided whether they were trustworthy. Chapter 1. Credit existed long before credit scores. Credit is older than banks, computers, and the United States itself. Anytime one person provides something valuable today in exchange for a promise of payment tomorrow, credit exists. A farmer might receive seeds in the spring and promise to pay after the harvest. A merchant might import goods and repay the supplier after selling them. A family might take food from a local store and settle the account when wages arrived. The central problem was always the same. How could the lender know that the borrower would repay? Modern lenders call this credit risk, but early lenders did not require a technical term to understand the danger. They knew that a promise was valuable only when the person making it appeared able and willing to keep it. In colonial America, business credit depended heavily on personal knowledge. A lender considered a trading partner's circumstances, previous behavior, reputation, and relationships. Credit was built inside networks where people knew one another or knew someone willing to provide an introduction. This meant trust could travel through human connections. A merchant might say, "I have dealt with this man for 10 years. He has always paid." A respected landowner might write a letter introducing a younger businessman. A family member might guarantee a debt. A local minister, employer, attorney, or shopkeeper might provide a character reference. In that world, a good name worked almost like financial property. Your reputation could open doors. A damaged reputation could close them. There was no single national score. Instead, every town and commercial network maintained its own informal picture of who could be trusted. That picture was often incomplete. A borrower could appear responsible in one community while owing money somewhere else. A merchant in Boston might know nothing about a customer's unpaid debts in Philadelphia. A person could move west, enter a new town, and present himself as financially reliable because his past had not followed him. This was manageable when commerce remained local. But America was expanding. People were moving. Railroads and telegraphs connected distant markets. Businesses increasingly sold goods to customers they had never met. Personal knowledge alone could no longer carry the entire credit system. Chapter 2. The local shopkeeper was often the first credit bureau considered a working family living in an American town during the 19th century. Their income might not arrive on a predictable weekly schedule. A farmer received money after crops were sold. A laborer could lose work during winter. A family faced illness, repairs, or an unexpectedly poor harvest. But people still needed food, clothing, fuel, and tools. The local general store often allowed trusted customers to buy those necessities on account. The shopkeeper wrote each purchase into a ledger. Flour, sugar, coffee, fabric, lamp oil, a pair of boots. Beside the customer's name, the merchant recorded the growing debt. When the customer received wages or sold a crop, part or all of the balance could be paid. That handwritten ledger was a primitive credit file. It contained no score, but it revealed behavior. Did the customer pay when promised? Did the debt remain manageable? Did the customer disappear when the bill became due? Did the family communicate honestly when it could not pay? The merchant also possessed information no modern algorithm could easily measure. He saw how often the customer entered the store. He knew whether the customer had steady work. He might know whether a farm was productive, whether a local factory was reducing employment, or whether a family had recently experienced hardship. Credit decisions were therefore based on a mixture of facts, observation, relationships, and instinct. For ordinary consumers, retailers remained a major source of credit even after formal financial institutions expanded. Research from the Federal Reserve Bank of Philadelphia notes that early consumer credit bureaus emerged when retailers were the primary providers of consumer credit. Other important sources included pawnbrokers, small loan companies, friends, and family. Banks frequently focused on commerce, property, and larger business loans rather than small unsecured loans to ordinary households. A bank could earn meaningful interest from a substantial commercial loan secured by valuable property. Investigating a small personal loan required time and paperwork, but the possible profit was limited. Retailers solved the problem differently. Rather than charging a clearly stated loan rate, a store could charge more for goods purchased on credit or offer different terms for cash and credit customers. That helped merchants make small-scale consumer lending worthwhile. So before asking how banks evaluated consumers, we must recognize that many consumers never reached a bank's desk. Their credit decision happened across a wooden counter inside a neighborhood store. Chapter 3. What a banker looked for. When a borrower did approach a bank, the decision usually belonged to a human being. The loan officer did not receive a 3-digit score. He assembled a picture. First, could the borrower repay? A bank might examine wages, business revenue, farm production, rent payments, or other sources of income. A merchant requesting a commercial loan could be asked to show inventories, account books, property, contracts, and outstanding obligations. A farmer might be judged by the value of land, livestock, equipment, expected crops, and previous harvests. Second, what would happen if the borrower did not repay? The bank preferred something it could claim or sell: land, a building, farm equipment, business inventory, valuable household property. A borrower with strong collateral could appear safer because the lender had a possible route to recovering its money. Third, how much of the borrower's own money was at risk? Someone who had invested personal savings in a farm or business might be considered more committed than someone attempting to finance everything with borrowed funds. Fourth, what was the borrower's reputation? Did other merchants trust this person? Had previous debts been honored? Was the borrower known as cautious or reckless? Did the borrower maintain steady employment? Would another reliable person sign the note? The Federal Reserve describes this older process as a judgmental system. A loan officer manually evaluated information and used personal experience to decide whether repayment appeared likely. Statistical scoring systems later standardized much of this work, but the basic goal remained the same: separating loans more likely to be repaid from those less likely to be repaid. The old process could be thorough. A skilled banker might understand a borrower's situation better than a score ever could. He could recognize that one late payment resulted from a temporary emergency rather than irresponsibility. He could understand a local business, industry, or farm in ways a distant lender could not. But judgment created inconsistency. Two loan officers could examine the same borrower and reach different conclusions. One might view the borrower as ambitious, another might view the same person as inexperienced. One might respect a new business idea, another might reject anything unfamiliar. The borrower was not only proving an ability to repay, the borrower was trying to win the confidence of a particular human being. Chapter 4. Your community could become your credit file. In a small town, privacy and reputation were closely connected. A banker might attend the same church as the borrower. Their children might attend the same school. The banker might know the borrower's employer, landlord, relatives, and business partners. This gave the lender access to information that never appeared on an application. A person asking for credit could be evaluated through quiet conversations. Does he still work at the mill? Did she pay her account at the furniture store? Is their farm producing enough this year? Has the family borrowed from anyone else? The lender might request references and then write letters or make personal inquiries. For a business loan, attorneys, suppliers, and other merchants could be contacted. A borrower without enough property could bring a cosigner. The cosigner did more than say the borrower had good character. The cosigner accepted financial responsibility if the borrower failed to pay. That transformed reputation into a real guarantee. But the system created a severe problem for anyone without an established network. A newcomer could have steady income and honest intentions, but no respected local person willing to speak on his behalf. Someone moving from another state might leave years of responsible payment behavior behind because records did not move easily. A person from a poor family might lack property and influential references. A wealthy borrower could appear trustworthy because of social position even when actual finances were weak. The system also allowed prejudice to enter the decision. When lenders relied on subjective ideas about character and respectability, judgments could be influenced by race, sex, religion, national origin, marital status, neighborhood, accent, clothing, and family background. A lender could call such a decision business judgment, even when the real reason had little connection to the borrower's ability to repay. This is one of the central contradictions of pre-score lending. It was more human. But more human did not always mean more fair. A human could listen to an explanation that a formula might ignore. A human could also deny an opportunity because of bias that a formula was later legally forbidden to consider. Chapter 5. Distant trade created a trust crisis. As American commerce expanded, lenders faced a new challenge. A merchant in New York might be asked to ship valuable goods to a store owner hundreds of miles away and receive payment later. Should he trust the order? The buyer might provide impressive references, but were they genuine? Was the business profitable? Was the owner already deeply in debt? Had the owner failed somewhere else and reopened under a new name? Sending an investigator for every transaction would be expensive and slow. America needed a system for transporting reputation across distance. During the 19th century, commercial credit reporting agencies began building networks of correspondents who collected information about businesses and their owners. Instead of personally knowing every potential customer, a supplier could purchase information from an agency. The report might describe the business, estimated financial strength, payment habits, property, reputation, and apparent ability to meet obligations. These reports did not begin as modern consumer scores. They focused heavily on merchants, manufacturers, and traders. R.G. Dunn and Company became one of the best-known commercial reporting organizations. The Library of Congress preserves its reference books beginning in 1859. These publications supplied ratings concerning businesses' financial strength and ability to repay debt and were issued multiple times a year. This was a major transformation. Previously, trust depended on being personally known. Now, trust could be packaged as information and sold to a subscriber. But early reports were not made entirely of objective financial data. Agency correspondents gathered opinions, they interviewed local sources, they evaluated the owner's reputation, habits, business ability, and perceived character. A report could contain useful warnings, but it could also contain rumor, personal judgment, or inaccurate information. The subject might never know what had been written. The old community reputation system had not disappeared. It had become organized. A private company could collect local gossip, commercial observations, and financial details, then distribute that information beyond the borrower's hometown. For the first time, a person's financial reputation could follow him across significant distance. That solved one problem for lenders. It created an entirely new problem for privacy. Chapter 6. Consumer credit bureaus emerge. Commercial agencies helped businesses evaluate other businesses. But as retailers extended more credit to ordinary households, stores faced the same information problem. A customer could owe money to several merchants at once. Each store might believe the debt was small and manageable because it could not see the customer's obligations elsewhere. Local merchants began cooperating. They formed organizations that pooled customer payment information. A furniture store could report that a customer was paying on time. A clothing store could report a delinquent account. A fuel dealer could ask whether the same customer owed money across town. According to Federal Reserve research, most early American consumer credit bureaus were cooperative or nonprofit ventures created by local merchants. Their purposes included pooling customer credit histories and assisting with debt collection. Some bureaus were organized by finance companies or chambers of commerce. These bureaus did not operate like today's instantaneous national systems. They depended on paper. A clerk searched filing cabinets. Requests moved by mail or telephone. Names could be misspelled. People with similar names could be confused. Records might be incomplete or outdated. Still, shared information gave merchants something they had never possessed before, a broader view of the customer's obligations. In 1906, a national trade organization was created to help credit bureaus exchange information across different cities and regions. It became known for much of its history as Associated Credit Bureaus. The organization developed common procedures, definitions, and formats that made files easier to share. The network expanded quickly, yet the fundamental decision remained human. A clerk supplied the file. A credit manager studied it. The manager compared the applicant's job, income, references, payment record, debts, and requested purchase. Then the manager made a judgment. There was still no universal three-digit number. Instead, there was a collection of facts, sometimes accurate, sometimes questionable, interpreted by someone sitting behind a desk. Chapter 7. Buying a car without a modern credit score. The rise of automobiles, household appliances, and other expensive products changed consumer credit. A family could pay cash for groceries, but a car or refrigerator required a much larger amount. Manufacturers and retailers discovered that monthly payments could turn an unaffordable product into something millions of households believed they could manage. General Motors established its financing company in 1919 and helped make installment purchasing more common in the automobile market. Secured installment credit also expanded access to appliances and other durable goods during the following decades. But how did a dealer decide whether to approve the customer? An application might ask for the customer's employer, length of employment, salary or wages, home address, length of residence. whether the home was owned or rented, bank references, personal references, existing debts, property, and savings. The dealer or finance company could telephone the employer. It could contact the applicant's bank. It could ask local merchants about payment history. It could require a substantial down payment. And the purchased car itself served as security. If the customer stopped paying, the lender could repossess it. This is crucial. Before highly developed credit scoring, lenders often reduced risk not only by studying the borrower, but by designing the loan so they could recover property. A secured loan was safer than handing someone cash with no collateral. The down payment also mattered. A borrower who invested personal money had more to lose by walking away. But the process was slow and uneven. An approval could require days or weeks. A customer known personally to the dealer might move quickly. A stranger could face more investigation. A well-connected applicant might receive flexibility. Another applicant with similar finances could be rejected because the credit manager felt uncertain. The system could work for thousands of loans. It became increasingly difficult when lenders wanted to approve millions. Chapter 8. Why human judgment could not scale. A loan officer can carefully investigate 10 applications, perhaps 100. But what happens when a national company receives hundreds of thousands? Each manual review costs time and money. The lender must employ investigators, clerks, and experienced credit managers. The cost may be reasonable for a large mortgage or commercial loan. It becomes a major obstacle when the company is offering many small consumer accounts that produce only modest profit individually. Judgment also creates variation. One manager values stable employment above everything else. Another emphasizes home ownership. Another trusts personal references. Another believes younger applicants are too risky. Even when a company creates written rules, employees interpret them differently. The Federal Reserve explains that judgmental systems can treat similar information inconsistently because loan officers bring different experiences and make different trade-offs. Statistical systems apply consistent mathematical procedures, although their results still depend on the quality and design of the underlying data. By the middle of the 20th century, three developments collided. Consumer demand for credit was rising. Credit bureaus had accumulated large amounts of payment data. Computers were becoming capable of processing information at unprecedented speed. Businesses began asking a powerful question. Could previous borrowers be studied to identify patterns associated with repayment? Instead of asking a credit manager which applicant seemed trustworthy, a company could compare the applicant with thousands of earlier customers. Which characteristics appeared most common among people who paid? Which appeared most common among those who defaulted? Could those relationships be converted into points? This was the beginning of statistical credit scoring. It did not eliminate judgment overnight. It turned judgment into a model. Chapter 9. When trust became a number. Credit scoring first entered wider lending use during the late 1950s, particularly in large retail stores and finance companies. By the end of the 1970s, most of America's largest commercial banks, finance companies, and credit card issuers were using scoring systems. Early models were often created for one particular lender. A department store studied its own customers. A finance company studied its own loans. The company selected characteristics that appeared to predict repayment and assigned values to different answers. The score did not measure whether someone was a good person. It estimated risk. That distinction matters. A responsible borrower can experience job loss, illness, or another crisis and default. A borrower predicted to be risky can repay every cent. Credit scoring deals in probability, not certainty. Fair Isaac was founded in 1956 and became an important developer of statistical decision systems. Computerization of credit information began during the 1950s, while larger city bureaus increasingly automated during the 1960s. Early scoring systems did not immediately produce the universal score people recognize today. Many models remained internal. One store's score might differ completely from another lender's score. The decisive shift came when large credit reporting companies developed electronic databases and lenders gained access to broader consumer histories. By the late 1980s, generic credit history scores were becoming available. Unlike a model built only from one lender's application data, these scores used information in credit reporting agency files and could be applied across many applicants and products. The banker no longer needed to know the borrower's family. The lender did not need a personal letter from a respected merchant. A borrower could move to another city and bring a financial record indirectly through the reporting system. Trust had become portable. It had also become less personal. Chapter 10. Did credit scores make lending fairer? Credit scores solved several problems. They made decisions faster. They reduced the cost of reviewing large numbers of applications. They allowed lenders to operate beyond their local communities. They created greater consistency because the same model could evaluate similar information in the same way. A person without a relationship with the local bank could still demonstrate a history of repayment. But scoring did not automatically eliminate unfairness. A model learns from data produced by the real world. When historical lending patterns reflect exclusion, unequal opportunity, or inaccurate records, those problems can influence the information available to future systems. Data errors can also cause real harm. A payment can be reported incorrectly. Two people's files can be mixed. An account created through identity theft can appear under the victim's name. And a numerical system may appear completely objective even when important choices were made by humans. Which data to include, which outcome to predict, how much risk to accept, and where to set the approval threshold. The older system had obvious subjectivity. The banker looked at the borrower and made a judgment. The modern system can hide human choices behind mathematics. Both systems therefore require rules and accountability. Congress enacted the Fair Credit Reporting Act in 1970. The law regulates how consumer reporting information may be collected, accessed, and used. It also places responsibilities on reporting companies, businesses supplying information, and organizations using reports to make decisions. The Equal Credit Opportunity Act followed in 1974. It prohibited certain forms of discrimination in credit decisions, initially addressing sex and marital status, and later expanding to additional protected categories. Current law prohibits discrimination based on race, color, religion, national origin, sex, marital status, age, receipt of public assistance income, and the good faith exercise of rights under consumer credit law. The goal was not to force lenders to approve unsafe loans. It was to require that risk be evaluated without using prohibited personal characteristics. Chapter 11. What the old system understood. That a score can miss. It is easy to imagine the old community banker as either wise or corrupt. The truth is more complicated. Personal judgment could recognize context. Suppose a borrower missed payments because a factory temporarily closed but had already returned to work. A rigid system might see only delinquency. A lender who understood the situation could see recovery. A small business owner might not fit a standardized profile, but could have strong customers, valuable skills, and a realistic plan. A knowledgeable banker could recognize those strengths. This is why judgment has never disappeared entirely. Large and complicated business loans still require detailed human analysis because every company, contract, market, and management team is different. The Federal Reserve notes that judgmental evaluation remains practical for complex, high-value lending situations that do not fit easily into standardized models. But personal knowledge also had a darker side. The banker might approve a weak borrower because they belonged to the same social circle. He might reject a strong borrower because the person looked unfamiliar. He might confuse respectability with wealth, race, gender, neighborhood, or family background. A score can overlook important context. A person can misuse discretion. Neither system is perfect. The real lesson is that lending has always required two questions. What information predicts repayment? And who gets to decide which information matters? Before scores, the answer came from the experience and beliefs of individual lenders. Today, it comes from a combination of credit records, mathematical models, institutional policies, laws, regulators, and, in many cases, human review. The decision has changed, the uncertainty has not. Chapter 12. What a credit score really replaced. A credit score did not replace trust. It changed how trust was represented. The old merchant trusted a familiar face. The 19th century supplier purchased a report about a distant business. The early department store searched a local bureau's paper files. The automobile finance company contacted employers and references. The modern lender retrieves data and calculates risk almost instantly. Each system tries to solve the same information problem. The borrower knows more about the borrower's intentions and circumstances than the lender does. The lender wants evidence before surrendering money. In the old system, evidence came through property, social relationships, observation, references, and reputation. In the modern system, evidence increasingly comes through recorded behavior. Did previous accounts remain current? How much debt exists? How long have accounts been open? Has the person recently applied for additional credit? The modern score is not a complete picture of a human life. It does not measure kindness, intelligence, work ethic, talent, or moral worth. It is a tool designed to rank the likelihood of particular credit behavior based on available information. That is why a financially responsible person can have little or no score. Without enough reported credit activity, the system has limited evidence to evaluate. The person may be trustworthy. The model simply does not know. Before national databases, nearly every newcomer faced a similar problem. A person arriving in a new community was financially invisible until someone extended the first opportunity. The technology has changed, but the problem of proving trust without previous access remains. Before credit scores, borrowing was personal. A shopkeeper watched how a family paid its account. A banker examined land, employment, savings, and reputation. A merchant wrote to distant contacts. A credit investigator spoke with neighbors and business associates. A co-signer placed his own money and name behind another person's promise. These methods built an economy long before computers could measure risk. But they were slow, they were local, they were inconsistent, and they often gave extraordinary power to the person making the judgment. Commercial reporting agencies allowed business reputations to travel. Local consumer bureaus allowed merchants to pool payment histories. National networks standardized information. Computers made enormous files searchable. Statistical models turned patterns into points. And eventually, the private financial reputation that once existed inside a community became a number available to lenders across the country. The modern system made credit faster and more scalable. It also created new concerns about accuracy, privacy, transparency, and the power of automated decisions. So how did banks decide who to trust before credit scores? They examined what you owned, they studied what you earned, they asked who knew you, they contacted people you had previously owed, they required collateral or a cosigner, and sometimes they simply looked across the desk and decided whether they believed you. Today, a model often makes the first judgment, but behind that model lies the same question lenders have asked for centuries. If we give this person something valuable today, what evidence suggests they will keep their promise tomorrow? The answer was once stored in a shopkeeper's memory. Then it was written in a ledger. Later, it filled cabinets inside local credit bureaus. Now it moves through databases in fractions of a second. Trust never disappeared from lending, it became data.